Welcome to the Build Wealth Canada podcast, where it's all about becoming debt-free, accelerating your wealth, and taking control of your money. Now, here's your host, Cornell Schreiber.
Hey, it's Cornell and welcome to the Build Wealth Canada show. If you own a home, are thinking about buying or selling a home, or have a mortgage renewal coming up, today's episode is here to help you make the best financial decisions in this changing market. And ultimately, my goal is to hopefully save you some money when it comes to all this, or at least make things a bit less stressful for you. We're bringing back our trusted mortgage expert and best-selling author, Sean Cooper, to first break down the potential impact that the new U.S. tariffs may have on our mortgage and real estate market here in Canada. Sean also goes over the new mortgage rules that you need to be aware of if your mortgage is coming up for renewal or if you're getting a brand new mortgage. We also cover what's happening in Canada's housing market right now. Is it more of a buyer's market or more of a seller's market? We cover different ways that you can make changes to your mortgage if you're finding cash flow to be a bit tight. There are certain levers that you can pull for that. And we also give an update on the fixed versus variable rate mortgage debate. Which is the better choice based on the current state of the mortgage market and interest rates here in Canada? Sean will help us navigate these big questions and, as always, provide practical advice that you can actually act on. Lastly, just so you know, Sean is a licensed mortgage broker. He's also the resident mortgage expert here on the Build Wealth Canada podcast. And as always, as a Build Wealth Canada listener, you can speak to him for free to get your mortgage questions answered. So thank you, Sean, for offering that to Build Wealth Canada listeners. He's also always looking at dozens of different lenders in Canada as part of his job as a mortgage broker to try to find the best mortgages currently available in Canada. So definitely feel free to reach out to him also if you want to see his research on the best mortgages that he's been able to find. And to get in touch with him, you can just go to buildwealthcanada.ca/Sean. That's buildwealthcanada.ca/Sean. SEAN. All right, let's get into the show. Sean, welcome back to the show.
Hi, Cornell. Great to be with you once again with the loyal Build Wealth Canada listeners.
Awesome. Sean, just since you last came on, can you give us an update on what's happening in the real estate market in Canada right now? And can you touch on what the repercussions might be of the new tariffs between the US and Canada? Is this something that could potentially affect our Canadian mortgage rates and real estate market?
Sure. Well, that's definitely a bit of a loaded question, but happy to go into detail there. So you always ask the easy questions first. But anyways, all kidding aside, I was just looking at the real estate forecast for Real LePage, for example, and you can look at the real estate housing market forecast for the other big real estate brokerages as well. But the bottom line is they made these forecasts before they knew anything about the tariffs. So they were predicting a pretty strong year for 2025. Basically, the message was that interest rates are finally came down. So the real estate market should really come back because it's been a bit depressed over the last while there because of the higher interest rates. Like the number of homes changing hands have been below the historic average there, which is understandable because if you take anything away from this podcast, it's that the single biggest driver of the real estate market is interest rates. So when interest rates are higher, the real estate market is slower. Whereas when interest rates are lower, then the real estate market really picks up there. So Wes, there was tariffs mentioned, but I guess we really didn't know how serious the new administration was about the tariffs. But now that we know that they're serious about that we just need to kind of get used to the new reality that we're in. So to keep things nice and simple, I mean, you could literally go on YouTube and watch 5 hours worth of talk on tariffs, but I'll keep it nice and simple for your listeners there. So short term, what tariffs means is that if tariffs are introduced, it means lower interest rates in the short term. But if we end up having a dragged out trade war where Canada and the US trade jabs back and forth, and this ends up going on for months and years. And that's when we could run into a situation where interest rates go up at some point in time, because essentially if the US introduces tariffs, which is basically a tax on imported goods. If the US introduces tariffs and then Canada introduces its own tariffs, when Canada does the counter tariff, it makes everything more expensive for Canadians. So that in itself causes inflation there. So that's where, again, if we end up getting in like a big trade war that goes on for a while, that's when we could run into a situation where interest rates go up. But speaking with economists and hearing them on the news and other things, they think that's a less likely scenario there. Because if we really get into a trade war, we'd be in a bit of an odd situation where inflation would actually be going up and economic growth would be going down, which isn't typically what is happening there. So the Bank of Canada basically has a couple of choices. Like, are they going to raise interest rates or are they going to lower interest rates? Most economists think that they're more likely to cut interest rates. But there's just kind of a bit less certainty out there these days with the Trump 2.0 presidency. And I won't talk about politics or anything like that. But that's definitely some interesting time ahead. But if you're not affected by these tariffs, you're not working in the auto industry, you're not in like steel or aluminum or anything like that there, then, and you're confident you can hold on to your job there, then 2025 could be a pretty good year real estate wise for you, especially if you've been struggling to find a property that you like just because of the lack of inventory out there. So as long as you can hold on to your job and you're not affected by the tariffs, then 2025 could be that good year to finally get into the market and find a decent property that ticks most of the boxes if you've been kind of frustrated over the last while with the lack of inventory and choice out there.
Now, is it more of a buyer's market or a seller's market? And what should we expect if we're considering buying or selling our home currently here in Canada?
Great question, Cornell. So it's kind of hard to talk about the whole Canadian real estate market at a high level there because real estate is such a local thing. Like even going down to neighborhoods and property types, like in a certain area, maybe East Toronto, like detached houses are doing well, but there's too many condos, so condos aren't doing so well. But just zooming out and talking about the Canadian real estate market in general, I don't think we're going to be getting back to the crazy bidding wars that we saw around COVID or anything like that. I think we're at kind of and again, it can vary from market to market, but I see 2025 as being a more balanced market and just better choice available for people looking to buy properties, which bodes well for both sellers and buyers because many people like to list their property, but they need to find somewhere they're going to move to, whether it's a lateral move or moving up in the market or downsizing. If there isn't a lot of choice available, then they just decide to stay put. And then that causes a problem because other people, first-time home buyers that want to get into the market, there's not as many properties available and it kind of like slows down the whole real estate market in itself there. So again, each market is unique in its own way there, but unless there's some big financial crisis happening, looks like 2025 is going to be a pretty good year where we're not going to see like the return of 20 people bidding wars or anything like that in some hot markets like Toronto and Vancouver. We're going to see a more balanced market where if you're making an offer on a property, you won't necessarily be the only one making an offer, but maybe there's 2, 3, 4 other people, but it's not going to be like 20 people like before. So I think that works out a lot better for buyers and sellers. And that's really the kind of like Goldilocks place where everybody wants to see the market at. So I think unless something unpredictable totally happens, like it looks like 2025 is going to be a pretty well balanced market, which puts both buyers and sellers on even footing.
That's great to hear. We're already experiencing all this uncertainty, right, with these Trump tariffs and what the repercussions are going to be and all of that. So at least it's nice to hear that on the mortgage side of things, on the real estate side of things, there aren't some other major things that are going to be driving the market into either extreme, either being very much a seller's market or very much a buyer's market. So, but like you said, I think it's important to emphasize the point that with real estate, it is very much a local thing as well, more so than kind of a macro level thing. Because like you said, there could be certain neighborhoods or particular cities where they're seeing one of these extremes. But I still like to ask that question to you just to see if there's any macroeconomic factors that are pushing things in one direction or the other. So I don't know, it's nice to see your projection like that. Again, with all this instability that we're seeing, all this uncertainty we're seeing on the investing side, at least hopefully real estate will be not another thing that we have to now worry about and stress out about because of all the uncertainty there. So that's interesting and good to hear. And now a quick message from one of our sponsors. Are you approaching retirement and wondering how to turn your hard-earned savings into an income stream? Introducing Sun Life's My Retirement Income Solution. This is available for those who have or have ever in the past had a Sun Life group savings plan through your employer. This solution is created for those who are nearing or in retirement and want to receive income tailored to a target age. How My Retirement Income works is that you pick a target age you want your money to last until, such as age 85, 90, 95, or 100, and then the solution offers a unique blend of income and growth potential to help your money last until your chosen target age. This automated process eliminates the need for repeated reassessment, and with this solution, your payments will be deposited directly into your bank account while still having the opportunity for your investments to grow. It provides flexibility, allowing you to have access to your money at any time without fees or penalties, along with an easy transfer to leave a legacy for your loved ones. Sun Life's licensed retirement consultants are ready to guide you through the process. To learn more about if Sun Life My Retirement Income is right for you, visit buildwealthcanada.ca/myretirementincome, all one word, to schedule an appointment with a Sun Life retirement consultant today. That's buildwealthcanada.ca/myretirementincome.
Are you buying Canadian? Well, why not invest Canadian? At BMO ETFs, we're committed to helping you build a brighter financial future because it's our future too. This is our home, and as Canadians ourselves, we know what you need to grow wealth right here in Canada. Visit bmoetfs.com for more.
One interesting finding is that more than 4 million mortgages, or about 60% of all outstanding mortgages, will renew over the next 2 years. So in 2025 and 2026, what should Canadians know when their mortgage is coming up for renewal and they are shopping around for a mortgage in 2025?
Yes, so that's a big statistic there. The biggest amount of mortgages in history are coming up for renewal in 2025 and 2026. So my message to the loyal listeners of the Build Wealth Canada podcast is it's more important than ever to advocate for yourself because lenders are going to be super busy. The sad reality is that when Canadians receive their renewal notice, about half of them or more in some cases just sign the renewal notice and accept whatever offer that they receive. So if you take anything away from this podcast here, it's that whatever you do, do not sign the renewal notice from your lender. Definitely always consult with an independent mortgage broker like myself. Be sure to reach out at least 4 months in advance. Sadly, I've had people reach out to me like a couple days before their mortgage renewal dates. Unfortunately, that's not enough time there. So try to reach out at least 4 months in advance there. I could still help you if it's about a month before renewal, but it's better to have some time so that we don't have to move at a breakneck pace or anything like that there. But it's not only about a competitive mortgage rate. Everyone wants a competitive mortgage rate, but you have to be asking yourself, what value did you get from your mortgage lender over the last 5 years or however long that you had the mortgage with them? Was it pretty much like you just signed up for the mortgage and you never heard from them at all during the last 5 years? They never did annual mortgage check-ins. If you have a variable rate mortgage, did they at least check in with you when rates were going up and talk about locking in, or were you pretty much on your own and you had to look out for yourself and make these decisions on your own? I mean, sadly, I find that's the experience with a lot of Canadians there. So you have to ask yourself, are you really getting good value with the current mortgage provider that you're with there? If the answer is no, then it's definitely worthwhile to look elsewhere, because with an independent mortgage broker like myself, I work with over 50 different lenders. And once you take a mortgage out through myself, I like to say, like, once a client, always a client. So once you take a mortgage out with me, then my commitment to you is that I check in with you at least once a year for an annual mortgage check-in, because a lot can change in that time period there. You could have lost your job or gotten a job promotion or taken on consumer debt. And there can be ways for us to roll it into the mortgage and save you money. So I like having at least a call once a year, because imagine I don't speak with clients for 5 years. I mean, a ton can change in 5 years. I mean, that's 2030. We might be all be in flying cars by then. I mean, I wouldn't count on it, but yeah, a lot can change in the next 5 years there. So it's definitely important to stay in touch. And I'm regularly monitoring my mortgage portfolio for all of my clients to see if there's opportunities to save money, which we'll talk about in an upcoming question here. But I'm always keeping an eye and proactively reaching out to mortgage clients. Like, I remember when COVID happened, I reached out to all my mortgage clients and just checked in to see how they were doing, because everyone was affected differently from the shutdown with the pandemic there. But yeah, like, basically when you work with an independent mortgage broker like myself, you get a trusted mortgage advisor at no additional cost yourself. Work with a mortgage broker. Maybe you've heard stories about mortgage brokers charging fees, but unless you have like bankruptcies or other credit issues, then my services, there is no direct cost for my services, and you get all the benefits of a mortgage broker at no direct cost for yourself there. So yeah, the bottom line is definitely don't just accept whatever offer that your current lender is sending you. Consult with an independent mortgage broker, and also ask yourself, like, it's not just about you can build a lot more wealth long term than like if you take a mortgage out with a lender who's never going to reach out to you, and the onus is on you because people get really busy there. So yeah, definitely 2025 and 2026 will be very interesting years there. And I think lenders are going to be super busy. So
Yeah, and even for somebody that maybe they don't want to use a mortgage broker. I mean, I've always used a mortgage broker back when we had mortgages. That's always been my go-to, because why wouldn't you want someone else basically shopping around for you and then seeing their research? And then in terms of the payment, it's not like you pay them directly. The lender ends up paying them. So it's the service you get without having to spend money out of your own pocket. So for me, it was a no-brainer, especially because it's not like you have to go ahead with them. Like, if they give you the mortgages and all of them are not as good as the one you're able to find yourself, well, then go with the one that you found yourself. But again, in my experience, whenever I worked with a mortgage broker, they were always able to get me a better mortgage. So even I remember like researching this a lot back, because I used to have a rental property and then we had a primary residence. And I remember finding more, I would still do my own looking around as well, in addition to using a mortgage broker. And I remember I was able to get really, really low rates. And then the mortgage broker was able to match that, but then they were able to give me better terms, like better prepayment privileges, things of that nature, which helped us pay off our mortgage faster. So that was a nice thing as well, where, and I would encourage listeners of the show that, don't just look at the rate, because at least, again, in my experience, the mortgage broker was always able to match the lowest rate that I was able to find myself, but they gave me way better terms than I was able to get myself, which gives you a lot of flexibility. Like, okay, if we move, what happens? Is the mortgage portable? There's all these different things that you want to keep in mind, in addition to just what interest rate am I paying. And actually, a mortgage broker like Sean, they can help you with that. They can ask those questions, like, what are the other components besides the interest rate that you should think about and consider, and which one is a good fit for you? What's more important to you versus less important? Things of that nature, because there's different mortgage types, things like that. And so you do want someone that's able to sort of custom fit for you. And I do like with mortgage brokers, because they're working with so many lenders, once they know more about you and they know your situation and what's important to you, and then they can say, okay, well, based, like in Sean's case, you said you work like with 30, I think, lenders, right? So in Sean's case, you can say, okay,
over 50 lenders actually, but yes.
Oh, sorry, over 50, right? Yeah. So then you can say, okay, well, based on what you told me, I think this, and this lender would be potentially a good fit based on what's your priorities and what's most important to you, which was always way more appealing to me than just saying, I want to go with lender X. And then it's like, all right, well, here's their offering. And it's a much smaller offering, right? Because it's just like, it's kind of like a take it or leave it approach, because you're just working with one lender. Whereas, why wouldn't you expose yourself to all the mortgages on the market? It is a very competitive place. But again, it can be pretty confusing and a lot of work, because, contract and it's written in legalese and things of that nature. And so it's nice to have someone that actually works in this day in, day out. and that's able to advise you accordingly. So again, when your mortgage is coming for renewal, like Sean, like you said, definitely shop around. Don't just sign the renewal. Like, you know what I mean? Well, why would you do that? Why would you shoot yourself in the foot like that? This is going to be one of the biggest expenses that you're going to have every year. So why wouldn't you put in the due diligence into making sure you're getting a good rate and then you're getting good terms? So yeah, even if you're not using a mortgage broker, shop around. But again, I do encourage people to use one. I've always used one and it's been a great experience. So before we move on to more questions, Sean, I want to say that you've been the podcast's resident mortgage expert for years now. I've had a lot of listeners of the show mention to me that you've helped them and they were really happy with how you helped them. And they continue to basically use your help every time that they're your mortgage, a renewal, that kind of a thing. So thanks again for that and for offering that for the listeners of the show and for, not charging them some fee or anything like that for that service. For anybody that has mortgage questions or would like to know the best mortgage that you've been able to find here in Canada, yeah, can you just briefly explain how it works when working with a mortgage broker like yourself, especially when it comes to payment? I've touched on this already a little bit, but just so that anybody new to all this doesn't maybe think that there are some fees that they have to pay to get their questions answered or to see your research or anything like that.
No, great. It's been a pleasure to help the Build Wealth Canada listeners over the years and look forward to helping them in coming years there. But to answer your question there, so the simplest way I like to explain it to my clients is that working with a mortgage broker is similar to working with a realtor. When you work with a realtor, there is no direct costs for their services. Like when you go and see, let's say you go view properties with a realtor for 10 hours, they're not going to send you a bill for 10 hours worth of their time. It's not like a lawyer where they have billable time or anything like that there. So it's different. Like, yeah, the simplest way to think about it is mortgage brokers are paid like realtors there. So the whole idea with working with a mortgage broker similar to a realtor is you want to have the introductory call just to make sure that you're a good personal fit. And we're both kind of interviewing each other to make sure we're both a good personal fit for each other. But similar to a realtor, like once you've had that introductory call, then that's when you want to make your decision if you want to take the next step with the mortgage broker, because yeah, we're both going to be investing a lot of time and working together. And I'm more than happy to invest my time and resources in helping out clients. But I just want the expectation to be like, once we determine we're a good fit for each other, I mean, as long as I can provide competitive options to the listeners and help them out, then, if we're going to be working together for many hours, then the expectation is that eventually you'll take out a mortgage for me so that I can afford to compensate my loyal staff and also pay my overhead expenses and stuff like that. But as you mentioned, Cornell, there is no direct cost for working with a mortgage broker. Maybe you've heard instances where mortgage brokers have charged fees, and really the only instances where that should happen is if you end up having to go with like a private or alternative lender. But if you have good credit and you don't have any issues like bankruptcies or consumer proposals or anything like that, then there really isn't a good reason to pay a fee in that instance there. Unfortunately, there are a few bad apple mortgage brokers out there that take advantage of people when they shouldn't be, but the regulator keeps an eye on those folks. And I get emails like from time to time saying that people have their license suspended. So definitely the regulators trying to police instances like that and get rid of those mortgage brokers out there. But that's why you don't want to just work with any mortgage broker. You don't want to just like Google mortgage brokers. You want to work with somebody who's known and trusted. So that's why it's so great to have like a relationship with the Build Wealth Canada podcast. Because when working with me, you're working with somebody who is trustworthy and who's not going to try to kind of take advantage of you like a few other people might out there. But yeah, as long as you have decent credit and there's no issues, and there should be no direct cost. So if you're working with a mortgage broker and these lenders, especially when you're busy with work and family and chores and other stuff like that, and you're just tired and you want to relax at the end of the day, the last thing you want to do is run around to all these different lenders. Whereas with a mortgage broker like myself, you could speak to me without ever leaving your house. You could be sitting on your couch and relaxing when you give me a call, having a glass of wine. I mean, whatever you want there. And it's a lot more relaxing experience. And switching mortgage lenders to a mortgage broker like myself it's not a complicated process or anything like that. It's not going to take 25 hours or anything crazy like that. I mean, if you provide all the information that's needed, we can, when all is said and done from beginning to end, it can take like 2-3 minutes, speak with a mortgage broker to make sure that you're getting that you're getting the mortgage product that you deserve there. So yeah, bottom line is there's no direct cost for working with my stuff here. We set up an introductory call to make sure we're a good fit for each other. And if we'd like to take a next step, that's when I'll present the listeners of Build Wealth Canada with several mortgage options, not just one mortgage option, because I've heard of mortgage brokers kind of being like almost pressuring people, being like, here's the only mortgage option, take it or leave it. Because unfortunately, some mortgage brokers, like, I don't know, if they send a certain number of mortgage files to a certain lender, they might win a trip or something like that, or they might get some sort of bonus. I don't operate that way. Like, I want to do what's best for my mortgage clients, as I operate through like word of mouth referrals. So people will definitely find out if you kind of place them with a lender that was in their own interest instead of the client's interest there. So at the end of the day, like, I'm here to serve clients, and I want to make sure that I do what is best for them there. But yeah, I'd love to speak with the listeners, just understand what they're looking to do. Even if you're not looking for a mortgage right now, there may be an opportunity to save yourself some money in terms of your mortgage, which we'll talk about in the next question there. But hopefully that clears things up in terms of how the relationship works. No direct cost for mortgage brokers. I get paid by the lender, and you save time and money by working with me. So why wouldn't you?
I can see it also being easier to switch lenders using a mortgage broker than just doing it yourself, because it's not like you do that project every year. You know what I mean? Like, people will have their mortgage for 5 years. So if you're switching a lender, you might have never done it before, or maybe the last time you did it was 5 years ago. And so I don't know, if I was going through that process again, if, like, we don't have a mortgage now, but when we did, I mean, if I was switching lenders, I would think, okay, am I going to get charged some penalty that maybe I overlooked, or, is there something I should be asking or making sure? Like, you do it so rarely that you don't know what you don't know. And so I would actually feel more comfortable working with someone, which is why I did work with a mortgage broker, because then I can say, okay, fine, we found a better mortgage with better terms or better rate or both. So let's switch. Okay, what do I need to do to transition to this new lender so I don't end up paying some extra fees I don't want to pay, or so I don't do something wrong and then there's some administrative issues? You know what I mean? Like, it's nice to have that someone there to assist you that does this on a day-to-day basis, instead of just you're doing it yourself and you're trying to do your due diligence and hoping you don't mess it up. You know what I mean? So that's my personal opinion on it. But yeah, we'll move on to the question, Sean. So thanks for clearing that up, because I think some people maybe haven't worked with a mortgage broker before, and so I just didn't want anyone thinking that it's like a lawyer or something, where it's like, oh, I charge X dollars hourly, and then people start wondering, well, should I really switch then? Am I really going to save that much if I'm paying them all this extra money? It doesn't work that way. So I think that's a valuable thing to know. For anybody that does want to reach out to you, I'll just mention real quick. So the page we built for you, I think this has been up for years now, because you've been a resident mortgage expert for years on the show. So thanks again for doing that, because I don't have the time and, to be honest, the interest to always be up to date on the latest mortgage rules. And so I appreciate you, as part of your job. You have to do that. You do that. And so it's great whenever I get mortgage questions from listeners of the show, I just say, okay, ask Sean, because this is actually his industry and he knows what's going on. And so in all these years, I've never had anyone say anything negative. It's always been positive. So, and again, so thank you for taking that off my plate, because I just don't have, after paying off my mortgage, I just don't have the passion for it anymore. But it is such an important, big thing for Canadians in their lives. So, I mean, it is something we can't just ignore, obviously. Yeah. So the page we built for you, Sean, is buildwealthcanada.ca/Sean. So just SEAN, buildwealthcanada.ca/Sean, SEAN. And that's going to basically take you to a page, and there's multiple ways to reach out to Sean there. And then that way he knows you came from the show and he can give you the help that you need, that kind of thing. Yeah. So enjoy that. And again, Sean, thank you for offering that to Build Wealth Canada listeners. They appreciate it. And I appreciate the help as well, because I get enough questions about investments and things. So this is nice to not have to also keep up to date on mortgages. All right, so let's move on to the questions here. With all these interest rate fluctuations, I'm sure many Canadians are wondering if there is an opportunity for savings with their current mortgage. Can you speak to this?
Sure, definitely. I'll just keep it short and simple and to the point. So yeah, if you're in a fixed rate mortgage and your mortgage rate is 5% or higher, it's definitely worth consulting with independent mortgage broker like myself, because there can be opportunities for savings. Basically, what I'll do is a cost benefit analysis. I'll run the numbers in terms of how much the penalty is expected to be and how much the savings is expected to be. And if it makes sense, I'll clearly show you the numbers there. So generally speaking, if you have a mortgage with a rate above 5%, that's when it could be worthwhile to break the mortgage. So definitely reach out to me if that's the case there. And if you have a variable rate mortgage and the discount that you have off prime rate is a lower amount, like let's say it depends on the situation, but let's say you have a discount of less than half a percentage point, like prime minus less than 0.5%, then it can also be beneficial to break your mortgage in that instance and even go with a variable rate with a bigger discount there. So yeah, again, I proactively look out for my clients and look at the mortgage portfolios and proactively reach out to mortgage clients in these situations here. So that's why, like I said, if you have a fixed rate above uh, 5%, or you have a variable rate and the discount off the variable rate is less than half a percentage point, or you're just unsure and you just want a second opinion, definitely reach out to me. I'd be more than happy to give you a second opinion and see if it would be worthwhile to break your mortgage. If we determine it's not worthwhile, you don't have to do anything. And at least you have the peace of mind that you're in it makes sense to stay with your current mortgage. But if we're able to find you savings, then we can move forward with another option and you have nothing to lose. So why wouldn't you do it?
Yeah, and just for some context, we're recording this episode in pretty much the last week of February 2025. So it's almost March 2025 over here. And so Sean mentioned those rates, like the 5%, for example, and when is a good time to kind of do this analysis. Now, obviously, these interest rates, they do change over time. The Bank of Canada adjusts the rates and the banks change the rates, things of that nature. And so if you are listening to this episode way past end of February or March 2025, and the rates have changed a lot, let's say, since then my suggestion to you would be just reach out to Sean, because like I said, he's literally in this industry. He sees the latest numbers, the latest offers, things of that nature. So he can tell you pretty quickly, okay, if this is what you're paying, here's what the current market is offering for variable rate versus fixed. And if you listen to past episodes with Sean on the show, I always ask him, like, well, what's better now, fixed versus variable? And we're going to get to that later, because again, the optimum answer can actually change depending on what's happening in the marketplace. And so again, this is what we have as of basically as of March 2025. But I know people listen to these episodes sometimes months after they've been released. And so if that's the case and you're not sure if those numbers still apply because you've heard about some interest rates increases or decreases, then again, reach out to Sean and he can say, okay, here's kind of, maybe it's 5%, maybe it's 6%, maybe it's 4%, maybe it changed. So he can at least give you some sort of gauge as to how your mortgage stands with respect to what's currently being offered. And then, okay, if you can get a way cheaper rate because something happened to the rates, okay, well, is it worth it if we factor in all the fees you would have to pay to cancel your mortgage, right? So in the past, Sean's talked about how basically he has this cost benefit analysis that he can do where, okay, if you do switch, what is it actually going to cost you versus what are the savings at this lower rate? Is it actually worth it? Because it may be worth it to stick with this mortgage because your rates, your cancellation fees are so high that it's just worth it to ride it out until it's time for renewal. You know what I mean? Or it might be the opposite. So this is very much like a personal thing that changes from person to person and also as the rates change over time as well. So I do encourage you to get a custom thing done here, especially with Sean. He can do that for free for you, as opposed to just kind of taking some blanket answer like, oh, 5%. Okay, I'm going to use that for the rest of my life. Well, hold on. Things change. That may no longer be relevant or the accurate number 6 months from now. So yeah, I just want to kind of throw that out there because I know, people like the rules of thumb. I do as well. But there are certain things where it's like, okay, let's get the latest numbers in there because this does fluctuate quite a bit with different variables.
That's very well said.
All right, awesome. All right, so moving on to the next question, cash flow. It's a big concern for a lot of Canadians. What are some strategies for homeowners to lower their mortgage payment?
Yeah, great question, Cornell. So I'm going to share 3 different strategies here. So if you're struggling with cash flow, and as you mentioned, mortgage is the single biggest expense for most Canadians there. So number one, if you are paying your mortgage on an accelerated basis, the simple thing to do is to switch to monthly mortgage payments or non-accelerated, like bi-weekly non-accelerated, because it's great to pay accelerated. But if you're basically like really struggling from a cash flow perspective and you can't afford to take family vacations and you're eating craft dinner every meal, I don't think that's just a good way to live for the next 25 years. So simplest way is you don't necessarily need to break your mortgage. You could just call up your lender and say, I'd like to switch from accelerated to non-accelerated regular mortgage payments. And that can easily free up like at least $100 a month, depending on the size of your mortgage, because many people sign up for a different like accelerated mortgage payment frequency and then they forget about that. And then they don't even think that like if they're struggling from a cash flow perspective, that they don't remember that they're paying accelerated. And what accelerated is, you're still paying the same number of mortgage payments that you would with non-accelerated, but you're paying the equivalent of 13 months worth of mortgage payments instead of in only 12 months. So the payments are higher than they normally would be. So just check what your payment frequency is. If it has accelerated at the beginning of it, then you can contact your current lender and ask them to pay it on a non-accelerated basis. And that can free up at least $100 of cash flow a month in most cases there. So that's the first way to do it. The second way to do it, if that's not enough for you there, depending on the type of mortgage that you have there, we can potentially extend the length of your mortgage there. The technical term is amortization period, but it's just like to say mortgage length because it's simpler terms there. But many of the mortgages from the big banks are what is called collateral mortgages. So if you have one of those types of mortgages, and many times they come with a home equity line of credit, but even if you don't have one of those, it may be a collateral mortgage. So if you have one of those types of mortgages, we may be able to extend your mortgage up to 25 years, and that can free up cash flow because the longer the mortgage term in periods of low interest rates, that's when you can pay down your mortgage more aggressively. But in periods of higher interest rates, and interest rates have definitely come down, but historically speaking, fixed rates have generally like started with a 3 in more normal times. So we're not there yet. The fixed rates are still starting with a 4%. So we're still above the historic average there. So there's nothing wrong with extending the mortgage a bit if you're in that situation where you're finding it difficult to pay the mortgage, so that you can kind of get through this period of higher interest rates and not have to go on a craft dinner diet or anything like that. And the third way to help with your cash flow situation is, it's really important, I guess, to look at the root cause of why you're running into this cash flow situation. So if you're finding it like a bit tight in terms of the cash flow, again, it doesn't hurt to definitely reach out to somebody like myself, a mortgage broker. We can look at your current financial situation and see if there's some sort of way to restructure your mortgage and your current debts so that you can be a better financial position and not, like I said, have to be struggling for the next few years and eat a craft dinner, because that's definitely not healthy to be eating like that for many more months and years to come.
Yeah, that's a really good point, Sean. I think really practical for people as well, because I think initially when you take on your mortgage, things may be going really well. You might be, dual income family. Things are good on the income side, and so you might think, okay, well, let's try to pay this mortgage off quicker, right? So some people don't want to pay it off quicker. Some want to pay it off quicker, and so you might start doing these things like doing the accelerated payments and doing the shorter length, right? The sharing amortization period, so that you pay as little interest as possible as a whole, right, over the life of the mortgage. And that's all that can be all well and good. But then, yeah, things can happen. Like maybe I was just thinking of a friend of mine as you were giving your answer. Like she, they have kids. They were both dual income. They have a mortgage, all of that. But then she lost her job, and she's actually been having quite a bit of trouble finding a new job in the area. And so, they used to be this high income, dual income family, and now cash flow was great. And now all of a sudden, because of their income, got cut in half roughly, and she's having trouble finding a job. So they're living off one income now. All of a sudden, cash flow has become tight just like that, almost overnight, right? And so in that scenario, it's like, well, yeah, maybe, we set up this mortgage to pay it down quicker initially, but maybe we should consider pulling these levers, like you said, with with changing the length of the mortgage or the accelerated payments, maybe taking that off, so that just to kind of get us through this tight spot before we get a new job, that kind of a thing. So I could see that being a really, really thing that maybe someone forgot about because maybe they set up their mortgage 4 years ago, and this is just something that they got used to paying every month. But there are levers here that you can pull to help you from a cash flow side. So no, I think that's really, really useful information, Sean. Thank you.
My pleasure.
And now a quick message from one of our sponsors.
It's the small things that make us Canadian. At BMO ETFs, all of our tickers start with Z. That's right, Z, not Z. From ZSP to ZEB, we know how to build solutions for the Canadian investor. So the next time you invest in ETFs, consider a Z instead. Visit BMOETFs.com for more.
And now a quick intermission to tell you about an additional free resource that you may find helpful. I often get asked what I personally invest in and why. So to answer that, I created an in-depth guide to explain what specific investments my wife and I held and continue to hold as we moved through the accumulation phase, where the focus was to grow our investments as quickly as possible, and then transitioning to living off our investments in our early 30s when we hit our financial independence number, and the focus shifted to living off our investments in a sustainable fashion long term so that we don't run out of money in our early retirement. These investments are literally where we have almost our entire net worth apart from our house, and is what we are living off right now. So I figure at the very least, you'll learn about some great investments to consider for your own portfolio. I explain why I pick those, and I do provide the names and ticker symbols of the specific investments so that you can look them up yourself. The guide is actually a live Google Doc that I continue to update as things change, so you can view it anytime to see what I'm currently holding and why. I get it that it can be super overwhelming with the thousands of ETFs and other investments to choose from for us Canadians, and so I hope this will make things easier and less stressful for you. You can access the live Google Doc at any time by signing up for free over at buildwealthcanada.ca/guide. That's buildwealthcanada.ca/guide. Enjoy, and now back to the show. Let's talk about fixed rates versus variable rates. I did say we were going to talk about this. We always have to bring this up because I know that's a big question everyone has. And then the answer keeps changing as well, right? Depending on what's happening in the market. So which one makes the most sense right now for Canadians when choosing a mortgage, considering the current interest rate and economic environment? And I realize, it's not like there's always the one silver bullet answer that's correct for everyone in every situation. But, because of these economic variables, there are times where a fixed might have a few more advantages, or a variable might have a few more advantages depending on what's happening. So can you speak to that a bit for somebody that is, like you said, a lot of Canadians are going to be getting, their mortgages are coming up for renewal. They're going to be wondering, should I go fixed? Should I go variable? What are the things they should be thinking about so they can make the best decision for them?
Well, looking at my magic mortgage crystal ball, I'm just kidding, but in all seriousness, so yeah, I'll just keep it nice and simple. I mean, I could literally give an answer that goes on for 2 hours in terms of this year, but I'll just keep it nice and simple. So if cash flow is your priority, if your payments are really tight and your cash flow is a concern, and you can't really handle any fluctuations in terms of your payment, that's when it can make sense to go with a fixed rate. But just be aware, when you do go with a fixed rate, you can potentially be leaving quite a bit of money on the table there. So if you're looking to maximize your savings, that's when variable rate can make sense. But just be aware that things can always change in the future. So we don't know what the next 5 years will look like. We have an idea in terms of interest rates, but really anything is possible. So it's just important to be aware of that when you do go variable, and just make sure that you can handle some fluctuation in terms of the cash flow there. But an advantage of the variable rate is a lesser known advantage is you do have the opportunity to lock into a fixed rate any time. So you could initially start variable and switch over to a fixed rate later on when it's more opportunity to do that. Because a lot of people, they might want to go fixed, but as mentioned, historically, fixed rates have started with a 3 and they're still starting with a 4 right now. So rather than locking into fixed rates starting with a 4, what you could initially do is go with a variable rate. And variable rate have come down to the point where they're actually pretty much equal with fixed rates. Variable rates were higher than fixed rates for quite a while there because the Bank of Canada raised interest rates so aggressively. And yeah, people weren't taking variable rate for quite a while there because I guess they just felt a bit misled by the Bank of Canada. When the Bank of Canada tells Canadians that when you're signing up for a mortgage, rest assured rates are going to remain low for a very long time. I'm just paraphrasing the Bank of Canada Governor Tiff Backlid, but he said something along the lines of that, and then he proceeds to increase rates at like the fastest pace we've seen in decades. And yeah, many people were happy about that there. But now that we've seen 6 consecutive rate cuts by the Bank of Canada, we've seen prime rate come down by a combined 2%. And people are definitely warming up to variable rate quite a bit. And I would say the majority of my clients are going variable these days and just seeing how things go. As mentioned, lots of flexibility with variable. You can stick with variable the whole time of your mortgage, or you can switch over to a fixed rate when it's a more opportune time to do that. And I would say the sooner the better. Locking into a variable makes sense because as prime rate continues to go down, the discount lenders offer off the prime rate shrinks. So definitely, if you're thinking of making the switch over to variable, it's a good idea to do it sooner rather than later. And something I always mention to my clients is that historically speaking, variable, you'll do a lot better than fixed rate. There was a study done by a professor here in Toronto, and he studied folks who took mortgages out between 1950 and 2000 over a 50-year time period. And he found that those who took a variable rate came out almost 90% of the time versus those who took a fixed rate. So if you took a variable rate, you would save more money almost 9 times out of 10 versus a fixed rate. So, I mean, I don't know about you, but I like those odds there. But again, you have to be able to handle some sort of fluctuation from a cash flow perspective there. If your cash flow is so tight that you don't have any really wiggle room, that's when it can make sense. Or if you're just somebody who's really risk averse and you don't even invest in the markets and you put all your money in GICs, I mean, I wouldn't really recommend that for anyone, but if that's the way that you are, then that's when it can make sense to go with the fixed rate. But I'd definitely be a lot more open to variable these days because it's just a lot more of a flexible product. Just 3 months interest to get out of a variable. Whereas fixed rates, it can really cost you an arm and a leg, especially if rates are going down, your penalty can really be inflated there. So again, don't go ahead and just sign up for fixed or variable based on like my just conversation here with Cornell. Definitely it's a personal decision and reach out to me. I'd be happy to have that decision with you. I actually run the numbers. I have a spreadsheet for people if you're interested where I'll run the numbers in terms of projected like Bank of Canada interest rate cuts. And I could see how much money you could save by going with variable versus fixed. If you're kind of on the fence in terms of that there. So yeah, definitely a lot more people are going variable these days. So if as long as you have some flexibility in terms of cash flow, I definitely think variable is worth consideration. Or you can even do what's called a hybrid mortgage, where you could do half fixed and half variable. So that's a possibility as well. Not a lot of lenders offer that type of product there, but I do have a couple lenders who offer that type of product. So if you're unsure about it, there's always the option of going to the hybrid mortgage. So again, this is a personal decision, and you want to speak with a mortgage broker about this. You don't want to just make a decision on the whim, but that's kind of the lay of the land of where things are at right now. And we're not sure what the new neutral rate would be, but most of the big banks are expecting that we'll see further rate cuts in 2025. Maybe we have another couple or another 3 rate cuts left, but definitely looks like based on working with my clients, like variable has really made a comeback. So I definitely not just automatically go fixed. Like many people just kind of have their mortgage decision on autopilot and just always go fixed. I would say definitely be open to variable and have that conversation, because in the current rate environment that we're in right now, definitely variable, I would say, is worth some serious consideration there.
Yeah, we always did variable back when we had a mortgage as well. And one of my main reasons for that was because I also remember seeing the different studies about how it's not guaranteed, but historically you would have been better off by going variable versus fixed in terms of how much you're paying, over the term of the mortgage. So it's not a guarantee, but it's like the odds are in your favor that you're going to end up paying less in interest if you go variable versus fixed. But of course, the negative to that, there's always pros and cons to this, just like with investing, right? But then the con was, okay, can you absorb the hit? If the interest rates do go up, right? And so in our case, we were okay. Can we absorb it? Yes, we can. We were dual income at the time, that kind of thing. So we're like, okay, we can do it. We're willing to take on that risk in order to pay the lowest possible thing. The other thing I'll mention as well, why I also like variable, and again, I'm not trying to make a blanket statement like everyone should go variable. It's just that was a good fit for us. And again, pros and cons, like with everything else. But the other pro of variable that I like, that I think is very appealing, is the cancellation rate. The cancellation fees are a lot less than that for that versus fixed. So for fixed, if you let's say you want to change your mortgage and you have a fixed rate mortgage, the fees that you pay to the lender for that can be enormous, like many, many thousands of dollars. Sean can speak to this even better than I.
I've seen a penalty as high as 40,000. It can just absolutely be astronomical. And the funny thing is, as interest rates go down, the fixed rate penalty gets higher. But the ironic thing is, as rates go down, your variable rate penalty actually gets lower. So they kind of have an opposite, they kind of go in the opposite direction there. So yeah, just variables is a lot more flexible of a product overall there. And one other thing that I want to quickly add here is that again, this is just general advice, but think about it. Do you really want to be locking in when we're in a declining interest rate environment? When interest rates are super low, that's the time that you want to lock in and secure that rate as long as possible. But when rates are expected to go down, that's not really unless your cash flow is super tight, that's not really the ideal time to be locking in. You want to be in a mortgage product like a variable that adjusts until we actually get to that lower rate that we've historically been at. And fixed rates are starting with a 4, they're not starting with a 3 right now. So yeah, when rates are still high, I would generally say variable makes sense so that you can ride it out and take advantage of it there. But yeah, when rates bottom out, that's when it can make sense to lock in, but we're not quite there yet. So that's why I think that variable is kind of the way to go for quite a few people.
Awesome. Thank you, Sean. And also, can you talk about all the new mortgage rules that were introduced since our last podcast, which was in March 2024 was the last time you were on? Can you speak to any new changes we should be aware of?
Sure. I'll try to keep this as short and concise as possible here because there's been a lot. I mean, it seems like, especially with us heading into an election and this year, 2025, I mean, it seems like new mortgage rules are flying out left, right, and center there. And people are having a hard time keeping track of it because there's so many new mortgage rules coming out there. So let's start with 30-year amortizations or 30-year mortgages. So for many years, first, if you're putting less than 20% down on a property, you're taking out an insured mortgage, you are capped at 25 years. Previously it was 30 years, but we're talking years back. So the return of the 2024 marked the return of 30-year mortgages or insured mortgages with less than 20% down on the property. Now there are some kind of fine print there. So first there seems to be some confusion out there, which is understandable. First, the announcement was made that you could only get a 30-year mortgage when putting less than 20% down if you're buying a pre-construction or new home. But then a few months later, it was expanded so that any first-time home buyer has the option of going with a 30-year mortgage. So I still have people asking me, isn't it only for new builds? But then I tell them, the government expanded it to first-time home buyers. So yeah, there's definitely a lot more flexibility out there when it comes to mortgages. If you're putting less than 20% down and you qualify as a first-time home buyer, that isn't necessarily straightforward. For example, if you bought a house many years ago and then sold the house and it's been at least 4 years, then you can be requalify as a first-time home buyer. Or if you've gone through a marriage breakdown, you can also qualify for a first-time home buyer there. So don't just think, I bought a house many years ago, I'm not a first-time home buyer anymore. Definitely speak with a mortgage broker like myself, and we can confirm whether or not you qualify for as being a first-time home buyer again. But those are some major changes there, because especially in expensive markets like Toronto, Vancouver, Calgary, those markets are more difficult to get into. So being able to use a 30-year mortgage to qualify just helps that much more. And also another big change that the industry
Sean, can I just jump in here for a sec? Just to make it friendly for anybody that's maybe in getting into mortgages for the first time and they're not familiar with all the terms. So, and feel free to jump in if you think there's a better way to explain it. But when Sean was talking about the length of the mortgage, like 30 versus 25, that's basically your loan amount and how many years it's spread over. And so the longer that number is, like let's say it's 30 years, well, that means it's going to be spread over a longer period of time. So the benefit of that is that you get lower monthly mortgage payments because it's spread over many more years. But the negative is that you're going to end up paying more interest in totality because, again, you have that mortgage now for longer. Like, let's say you have it for 30 years instead of 25. So you're going to be paying more interest over the life of that, of your mortgage life. Whereas if you keep it short, like let's say 25 years or less than that, okay, well, in that case, you're going to be getting a bigger cash flow hit every single month because now that loan is spread over less years. And so your monthly payment is now going to be bigger because we're not spreading the loan over as much. So on the cash flow side, that it's worse. But in terms of totality, you are no longer holding that mortgage for as long. And so therefore, over the life of all that, you're going to be paying less interest in total. So again, it's kind of pros and cons. And that's why Sean was saying, if you've got these giant mortgages, well, if you've got a longer length of all that, like if you're using 30 years, that makes the cash flow month to month a lot more reasonable. Sean, did I explain that correctly? Did you have anything to add? I just want to make sure this is friendly for anybody that's maybe, because I know we have a lot of mortgage renewal people here, so they probably already know this, but maybe someone that's just getting into this for the first time, like they're fresh out of school. Would you explain that differently, or what do you think?
No, thanks for jumping in. That was a very good way that you explained that there, Cornell. What I like to do for all my mortgage clients is I like to offer them a 25-year option and a 30-year option so that they can see the difference in payment and also see the difference in projected interest over the cost of the mortgage so that they can make an informed decision there. So yeah, some people, it makes sense to go with a 30-year because they want that extra cash flow flexibility. Like they want to be able to contribute to their RSP and TFSA, and they want to have enough cash flow to do that because they believe that they can earn a better rate of return by doing that. For other people, they just want to keep the mortgage as short as possible, go with 25 years, and then they can do some extra payments and pay it down more aggressively. So everyone's financial situation is different, but I like to offer like the 25-year and 30-year option, and then talk about the pros and the cons, like you did, Cornell, and we'll let them make an informed decision there. But you did a perfect job, so thanks for jumping in there. So yeah, definitely, there's more options when it comes to mortgage term length. If you're putting less than 20% down on the property as a first-time home buyer, or when buying a new property. Another big change is that for insured mortgages, again, less than 20% down on a property, you can spend up to $1.5 million on a property. That was previously capped at $1 million on a property, which basically means if you wanted to spend $1 million on a property, you instantly had to put 20% down on the property. So going from putting 5% down on the first $500,000 and then 10% down above that, going from like a down payment of less than $100,000 to magically jumping to a $200,000 down payment. I mean, that's a pretty big jump there. And in expensive real estate markets like Toronto and Vancouver, that was kind of keeping people out of like the market for homes above $1 million there. But what the government did is they increased the insured purchase price to $1.5 million. So what that essentially means is you can spend up to $1.5 million on a property, and you can, as long as you're below that $1.5 million purchase price, you don't have to put 20% down on the property. It's 5% on the first 500,000 and then 10% on whatever amount is above that there. Now you have to be able to qualify for that there. And if you're spending up to $1.5 million, I mean, unless it's a couple of lawyers, it can be kind of tough. But a way to counteract that is you could have like a parent, or one parent or both parents co-sign on that. There's pros and cons of doing that there. But the bottom line is there are more options for people buying in expensive real estate markets like Toronto and Vancouver, which is welcome news because the industry was definitely pushing for an increase to that $1 million purchase price because it had been frozen there for many years. So that is definitely welcome news there. And the last big piece of big news is that the mortgage stress test has been dropped when you are switching mortgage lenders, when your mortgage comes up for renewal, which is great news because many people weren't aware, but when your mortgage comes up for renewal, they just thought that, oh, I only need to qualify for the stress test like when I purchased my property. But that wasn't the case previously. When you switch mortgage lenders, you had to pass a stress test. Most people could pass it, but if something changed in your financial life or because the mortgage rates are higher than when you renewed, there are some cases where people wouldn't qualify for the existing mortgage that they have and they basically be stuck with their current lender and they wouldn't be able to switch mortgage lenders. The good news is that there is a bit of fine print there, but essentially when your mortgage is coming up for renewal, you can switch mortgage lenders and there's no stress test to pass, which is great news because that's something we've been pushing for as the mortgage, the mortgage industry there, because it's just anti-competitive to say like, you have to pass the mortgage stress test to switch mortgage lenders. Like you're basically stuck with your current mortgage lender, which really doesn't make sense. I mean, I could understand having to pass the stress test if you are looking to borrow more money and refinance your mortgage. But if all you're looking to do is leave your mortgage the way it is and switch to a new mortgage lender, it doesn't make sense to pass the stress test. So the good news is that has been dropped in. Just to remind lenders about the stress test, basically that means that you have to qualify at a mortgage stress test rate, which is 2% higher than your mortgage rate. So let's say you want to switch to a new lender, the rate is 4.5%. That means you have to prove that you have sufficient household income to qualify at a rate of 6.5%. So previously, that wasn't just for purchasing properties. It was for also switching mortgage lenders, even if you were not refinancing or making any other changes. But thankfully, the industry has been advocating for that rule to be removed because it was anti-competitive. And finally, the regulator has listened. So that's really good news. And there's some smaller rules out there, but those are really the big ones. So I would say if you are concerned about qualifying to switch lenders and in the past, definitely the rules have changed. So it's worthwhile to reach out to a mortgage broker because it's easier than ever before to switch mortgage lenders. And thankfully that stress test has been removed when switching lenders because that rule made no sense to me in my opinion.
Yeah, especially if somebody has a bad rate on a mortgage and then so they want to switch to a better mortgage to help alleviate their cash flow. And it's like, nope, you gotta stick with the existing lender where you're overpaying, which is gonna hurt your cash flow. So it's like we're trying to improve our cash flow situation here, and you're not letting us because you're not letting us pass the stress test. So I'm glad they fixed that. That seemed like a pretty big mistake for trying to help Canadians get out of tough spots, like if one of the people lost their job or something like that. All right, awesome, Sean. So thank you for that, and again, thanks again for the update and for sharing your expertise with us. For anybody listening that has questions for you or would potentially like to work with you or see your research on the top mortgages that you've been able to find here in Canada as a mortgage broker, can you tell us more what the process is for Build Wealth Canada listeners to get a free introductory call with you? And then again, the link I mentioned earlier where you can sign up to speak with Sean for free, it's at buildwealthcanada.ca/Sean. So just SEAN, buildwealthcanada.ca/Sean. So Sean, take it away.
Yes, so it's a pleasure once again being on the podcast there. I'll just keep it short and sweet since we've been speaking a while here. But essentially, if I'm more than happy to always speak to the listeners of the Build Wealth Canada podcast. So visit the link that Cornell provided, buildwealthcanada.ca/Sean. And there you can book a call with me, or you can send me a message as well if you're not ready to book a call at that point in time. And I'd be happy to speak with you for an introductory call just to see if I'm able to help you, and you have nothing to lose. And it'd be a pleasure to speak with the listeners. And like I said, 2025 is going to be a really hectic year for mortgages, and your current lender is going to be so busy that probably don't have the time to give you the attention that you deserve. And I'm always happy to help the Build Wealth Canada listeners. So why not speak to somebody who gives you the attention that you deserve and you're not being just like passed off as a second thought there with your current lender? Because I don't think that's any way to treat somebody who's been loyal to the lender and been with them for many years. But sadly, most of the time you're just sent a mortgage renewal notice in the mail and they just want you to tick a box and they don't even want to speak with you there. So I offer all my clients the white glove or red carpet treatment. So definitely if you don't want to just tick a box, and I wouldn't recommend that for anyone, and you want to at least speak to a human being and get the high level of service that you deserve, be sure to visit the link there, book a call with me, send me a message, and I'd be more than happy to help you because as we said earlier, the Your mortgage is most likely the single biggest debt of your lifetime. You work really hard at your job, so at least dedicate some time to your mortgage and don't just tick a box, because it really makes no sense to do that. Switching mortgage lenders isn't a lot of work, so let me do the heavy lifting for you. I just need a few basic details, and I'd be more than happy to put a mortgage proposal together for you and show how I could potentially help you out and help you build wealth and save money long term as well.
Awesome. Yeah, I mean, at the very least, if you're renewing a mortgage or you're looking for a brand new one for your first one, I mean, you want to look at the menu. You want to see what's up there. You want to see what's available. If you were buying a car, you're probably not just going to go to one dealer and see what they have and take whatever they offer you, right? You're probably going to shop around. You're going to do some research, that kind of a thing. And so same thing with mortgages, right? You're going to be paying thousands of dollars into this mortgage as well. So why wouldn't you see what mortgages are available in the marketplace instead of just, I don't know, going one with one because, oh, I just happen to bank there already, so it'll be convenient. I'll just do that. Well, okay, but what if that means you're going to be paying thousands of dollars more over the course of the mortgage because you went for this easy approach? You know what I mean? So like I said, this is not like we're not clipping coupons here. We're not trying to save you 10 cents on, a can of tuna here. This is a mortgage. It's thousands of dollars. These little percentage changes can make huge differences in terms of your cash flow, in terms of your net worth, because every dollar you save, you could potentially invest. This is one of those things where you do really want to optimize it. I talk about optimizing our investments a lot. I talk about optimizing our taxes a lot. Well, this is another third component for many of us, because most of us do have mortgages. And so this is also something where it actually does move the needle for you. So thanks so much, Rashawn, for coming on. Thanks for keeping up to date on all these changes. There's always new ones. So I'm so glad I have your help and I really appreciate it. Thanks again for coming on. And until next time.
Pleasure. Thank you, Cordell.
All right. Take care. Bye. All right. I hope you enjoyed the episode. Please share it with someone that you think may find it useful. And of course, leaving a review on Apple Podcasts or Spotify is always super appreciated as well.
Thanks for listening to the Build Wealth Canada podcast at www.buildwealthcanada.ca.